mula. Jadi kita belajar sama-sama, Okey, nombor 1. Korang buat elok tau. Kalau tak ada rembang nanti. Okey, nombor 3.
Puan, lor ini bos kami dah beli. Dia tak kasih buat aktiviti kat sini tau.
Apa-apa pun tak nak.
Cik.
Cik, Pai! Sekolah ni tempat bisnes aku. Bukan tempat untuk kamu semua main-main. Faham? Aku dengar nama orang tak letak kima yang lengkap. Tak tahu datang dari mana. Kalau mau belajar, kamu pergi cari tempat lain. Diamlah. Jangan buat bising. Customer aku sudah komplain.
Saya faham Cikgu Siti. Tapi budak ni tak ada sijil lahir, tak ada dokumen.
Tak bagi budak-budak ni pergi sekolah kan? Tak apa. Biar aku je yang dekatkan sekolah dengan diorang.
Boleh tak saya tukar apple ni dengan buku tu?
Yang ni? Boleh je. Nah. Tak apa, awak simpan je apple tu, okey?
Betul ke?
Betul.
Terima kasih, Kak.
Okey, so A untuk?
Apple.
B untuk?
Ball.
C untuk?
Cat.
Walaupun dia tak ada dokumen, Cik, dia tetap ada masa depan.
Peraturan tetap peraturan.
Kalau dah tak ada jalan lain, Cik, memang masa depan budak-budak ni tertutup selamanya, Cik. Budak-budak ni tak minta kemewahan. Dia cuma minta peluang. Kalau maksud sebenar raya adalah untuk buka pintu dan hati, inilah masanya tuan-tuan dan puan-puan. Untuk kita buka pintu untuk mereka ni semua. Bos, shop kita terbakar sebab ada orang buang rokok. Kita kena cari tempat lain.
Mr. Lim, saya nak jumpa awak ke rumah terbuka hari raya nanti.
Bukankah itu maksud sebenar raya?
Pergi! Pergi!
Dulu aku fikir sekolah untuk yang ada. Cikgu ajar ilmu untuk semua. Walau datang tanpa nama, di sini kami semua diterima.
Haji, bye-bye, bye-bye. Tempat ini tempat ini nama orang pakai je. Tapi jangan bising sangat.
Cikgu nak awak ingat satu pesan cikgu, okey? Ilmu yang kita ada, kita kena kongsikan dengan semua.
Tahun depan boleh tak saya ajar budak baru?
Boleh.
Terima kasih. kasih cikgu.
I want one of my kids in Chocolate to become the future leader. They can be proud of themselves telling that I'm the street children that came out from the Bujang and Chocolate. And I'm here to change humanity. I'm here to change how people live. Okay, done.
Good morning, everyone. Welcome to the Morning Kappa at 8 on a Wednesday. I'm here to present the Midweek Futures Traders Technical Brief, and we are on week 1, April 2026. Let's dive straight into the most popular products traded by traders during the week. And we have seen that most of the indices indeed have shown very negative performances. This has been due to the ongoing geopolitical tensions in the Middle East. And also, there has been a lot of so-called news, which has been coming out from there, especially from the US President Donald Trump. And markets have not been behaving in a way which is easy for traders. So the news part is something that we have followed quite a bit, and we find that there are certain times news have actually appeared during the weekends, which impacted markets on a Monday. And for this reason, we have tried to identify those which may not be impacted as much, for trading purpose. But for those who are still very adventurous and going for the very volatile products, the advice would be that, you should be trading intraday and don't carry over the weekend. That would be the recommendation from our side. We have seen that many traders have actually been not able to handle the volatility, and come the new week, the traders were scrambling to cover positions which turned sour, which were looking good on the Friday before. So this would be the insight from futures. Let's go into the product of the week. We are looking at our market guide for gold. As we all know that over the night, US President Trump has told America's allies to fight their own battles, as he warned he was prepared to walk away from the blockaded Strait of Hormuz in a major retreat in the Iran war. The president has singled out the UK as well as Spain and also France as he tore into countries struggling to find fuel, telling them to buy American and secure the straits themselves. So there is actually a intention to retreat, but the president may have a difficult situation to handle, as the war has actually gone into a very deep state, and Israel does not seem to be supporting the move to end the war that fast. So in our perspective, there is still going to be a lot of the momentum that is going to be seen in markets, and therefore there is one which we are looking at currently is actually micro gold. gold has rebounded from the low, and as seen, is still trying to perk up a bit. And assuming that the war does actually go into a truce and the attacks on Iran slows down, there would be probably a major pullback on gold. So for this, we would recommend that we look at the gold currently. For the short-term setup, it is negative. The price currently is 4705. Reference price that we are looking at is 4630, and looking at a potential profit price of 4490, which will give us a value of USD 1004, and also a potential loss price if it fails, goes above the 4007, giving a value of a loss of 700 US dollar. The next product we are looking at for our market guide, this was actually been shared last evening, and in particular, we like soybean because it is a proxy for, and also it has got its own fundamentals that are looking pretty good at the moment. So currently, US farms have been planning to grow less on corn and more soybean this year in the face of rising energy and also fertilizer costs. It's another sign of a far-reaching impact of the Iran war. In 2025, growers have signaled more corn and fewer soybean. This year, the pendulum has swung back, and therefore, there is going to be a lot of focus on to the planting side, and also the plan to the reduction on the corn, which would give the general agri segment a boost. So I think this is something we will be looking at. And as mentioned, soybean oil has been recovering from the low, and the charts are looking pretty positive. So therefore, we are looking at this as a basis for our positive short-term chart setup. And as mentioned, this was shared yesterday. The reference price has been triggered at 68.60. Current price at the time of writing this morning is 68.88. And therefore, for this potential profit would be the levels above the 70.10, giving us a value of USD 900. And for circumstances which may turn against this particular setup, it would be a potential loss below the 67.30, giving us a USD loss of 780. Moving into the last slide here, this is our campaign for Futures Trade with Passion 2.0. This is a incentive for those who open an account with us, and we will grant you all a 500 ringgit free brokerage online buys for 30 days. So take advantage of this campaign that we are having. And this is all from me. I will pass on to Aiman for his sharing. Thank you.
All right, morning everyone. Welcome back. Aiman here. Okay. So looking at the S&P 500, well, it jumped nearly 3%. I think the best performance we've seen in quite a while so far. Following the news that Trump expects the US troop to leave Iran within the next 2-3 weeks, right? So I think this announcement has also really lifted the I would say the dark cloud over the market. As it suggests that the conflict might be ending much sooner. Fingers crossed, right? I think because of this also, oil prices are starting to come down, which helps lower the inflation worries as well. I think for now, the mood is very positive. The market look forward to return to more normal global trading condition. Right, so if you look at the China A50 futures, where we saw a bit of, I would say, tug of war yesterday. The market moved sideways and ended slightly lower by 35 points, right? So on positive side, I think China's factory data for March was great, right? Following the fastest growth we've seen in a year. So, however, I think this good news was cancelled out by the new reports of a tanker being hit near Dubai. Um, but for now, I think the market is stuck between the recovering economy at home for China and war abroad, right? So we do expect things to stay choppy and expect the market to stay in its consolidation mode for quite some time unless a new I would say a new push could emerge. Okay, for the WTI crude oil prices futures, right? Well, we saw a bit of a pullback yesterday, closing near $101, reaching as high as $107 in the earlier session. So I think the main reason for the drop was a surprise comment news from the President Trump, who said he expect the U.S. forces or troops to leave Iran within the next 2-3 years, just like what I mentioned just now. Okay. And I think while this news helped lower the war panic for today, tomorrow, right? So, but still keep in mind that the oil still finished the March with a record of, I think, probably somewhere around 50%. So we are watching closely to see if the withdrawal timeline is realistic or not. But yeah, for now, we still keep our positive trading bias aiming for the $110 level following the recent breakout from our resistance level. Right. Looking at the our Malaysia market, well, during the Tuesday session or yesterday's session, the KLCI as well as the FKLI both managed to finish slightly higher, just slightly higher. Although the market mostly moved sideways, I think it was a day of mixed news yesterday. We saw fresh tension from the Middle East after the Dubai tanker got hit, but this was balanced by the comment from the Trump as well, saying that suggesting that the peace talks are finally making some progress, hopefully, right? So I think our local market was saved by a strong buying in big banks, also the healthcare stocks, and we even saw plantation stocks like the Plantation performing very well. So for today, we do expect the market to stay. I wouldn't say sluggish, but wait and see range as traders watch for more updates on the war. Right. So I think we saw a steady performance also from our banking giants, specifically those Maybank, Sian-BNM, which also helped to keep the positive territory for KLCI despite early session fluctuations. So I think beyond this, blue chips, right? There's also a notable interest in those telco stocks as well, with Axiata as well as the Celcom Dici posting more gains. I think, however, the energy and also the plantation sector were a bit quieter, right? As the commodity prices to stabilize. So, yeah, I think overall was on the active list, right? I think the Certrix and also the Capital A, continue to see a high trading volume, right? So in terms of the sector performance, I believe most of the sectors are in a bargain hunting mode, right? As the modus, I think, as most of it rebounded yesterday. So top gainers are still coming from the healthcare sector, together with the utility sector as well. As both of these inching up as much as 3.1% and also 1.5% respectively. So in terms of our Malaysia trading stock, so today we have SAM Engineering and Equipment. So the stock is on its pending breakout formation at 3.20 cent level on a strong volume. So with that, we expect the momentum to keep bullish and the stock able to propel higher to test the next resistance at 3.35 cent, followed by 3.50 cent level. So if the stock to clear below this 3.5 cent support, I think this could reverse the cost and may trend lower. Also, next we have YTL Power International. So the stock is experiencing a breakout at 2.95 cent level. So if the stock remains bullish in a bullish formation, we're expecting that the price to reach 3.15 cent in coming session. Second resistance is at 3.35 cent level. Do keep an eye at 2.75 for any attempt of a reversal, together with the crossing below the 21-day moving average. And lastly, for the FCPOI finish the day higher yesterday, closing at 4,828 ringgit, as we saw a strong recovery in the afternoon session. So I think the energy spike recently is making the palm oil the go-to cheaper alternative for many industries, right? So also we are keeping an eye on the war as shipping delays are making it more expensive to move the goods nowadays, right? So I think for today, expect the market to stay firm as it continues to track the global rally. And at this juncture, we still hold our positive trading bias unchanged, targeting for the 4.9 to 5 resistance level, also together with the second resistance at 5,100 level. And we do keep our stop loss at 4,400 level. Right. So I think that's all from me. Pass the floor to the next presenter. Thanks, everyone. Happy trading.
Thanks, Aiman. So good morning, everyone. Just a quick update on the release of the BNM annual report for 2025, which they also released their economics outlook for 2026 as well. So overall, as what we see in the report, so the central bank still remains vigilant amid the global uncertainties, but they also highlighting that Malaysia's strength to withstand the external challenges. So Malaysia is in a position of strength, so underpinned by a robust domestic demand, moderate inflation at current stage, sound financial sector, and resilient external position, according to the central bank, which enable Malaysia to withstand a challenging and uncertain global environment. So Bank Negara Malaysia actually projected this range of growth, this year growth at a range of 4 to 5%. So while we still maintain our in-house GDP forecast at 4.7% for this year. So for the inflation wise, the central bank noted that the headline inflation is expected to stay moderate, averaging at around 1.5 to 2.5% in this year. So with the outlook largely dependent on the external risk, with the Middle East tension being cited. So domestic policy measures and stronger exchange rate, however, are expected to help contain the import costs. Meanwhile, monetary policy decision will continue to be guided by the assessment of risk to Malaysia inflation and growth, taking into account underlying economic and financial condition as well. So as highlighted in their economic and monetary review report, so Malaysian growth is expected to be underpinned by robust domestic demand in this year. However, the central bank has also expressed the concern over uncertainties in the economic outlook amid potential downside risk from slower than expected global trade due to geopolitical tension in Middle East and also tariff pressures. However, the diversified export structure and other supportive factors are expected to cushion the impact as well. So we remain mindful our in-house of developments in the external environment amid ongoing Middle East tension and also potential changes in the US tariff policies and their spillover effects on Malaysia economy. So in previous thematic report, we also are highlighting that 1% increase in the oil prices is associated with around 0.02 percentage points slowdown in quarter-on-quarter GDP growth for short run. So holding other factors constant. So when you translate into a yearly impact, annual impact of around 0.05 percentage point decline in GDP for every 10% increase in oil prices are actually anticipated if the tension actually prolonged. So meanwhile, so we also think that impact of external shocks will be partially mitigated by robust economic fundamentals as well. So on the inflation front, central bank opined that the headline inflation is expected to remain moderate, averaging at around 1.5 to 2.5% in this year. So inflation outlook will primarily dependent on external risks. So while global commodity prices may be volatile due to the Middle East conflict, according to the central bank, stronger exchange rate and domestic policy measures are likely to contain some of the import costs. So cost pressure for firms are expected to stay manageable, with cautious pricing across retail and services, pointing to a relatively contained inflation path as well. Meanwhile, for core inflation is expected to remain near its long-term average, reflecting economic activity aligned with potential and limited demand-driven pressure, averaging at around 1.8 to 2.3% this year for core inflation. So on policy front, central bank highlighted that the monetary policy decision will continue to be guided by the assessment of risk to Malaysia inflation and growth outlook, taking into account underlying economic and also financial condition. As such, policy will remain data dependent, with MPC closely monitoring developments and their potential spillover to the Malaysian economy as well. So we think that OPR, our baseline is to remain unchanged in this year at 2.75%. So provided that the headline inflation remains within the projected range of 1.5 to 2.5%. So monetary policy is still likely to remain data dependent in the upcoming MPC meetings, as what we see in the annual report and also in the previous MPC statement. Decision hinging on economic growth prospects and underlying inflation momentum as well. So for now, current economic environment and inflation trajectory, in our view, support a broadly stable policy outlook with no immediate pressure for rate adjustment. However, should inflation prove to be higher and more volatile than expected, especially in the environment of elevated oil prices, a 25 basis point rate hike cannot be entirely ruled out for this year. So that's all from me. I'll pass the line to the next presenter. Thank you.
Yeah, hi, good morning. Okay, so today we've got a Plantation report, just talking about the latest development, which is basically that Indonesia's B50 mandate that will take place now from the 1st of July 2026. So yesterday, there was no official announcement. So the day before, there was no official announcement, and today they have come out with the official announcement to say 1st July. So in addition to this, they will also limit subsidized fuel purchases to 50 liters per vehicle, and this will take effect from 1st of April. So obviously, this is going to be positive, and it has been positive for CPO prices and demand. But as it is a half-year implementation, B50 will actually increase palm oil demand by about 1.5 million tons for this year of 2026. Also, as mentioned in our previous report, at the current POGO spread, there is more than enough funds to subsidize B50 with capacity utilization that will increase all the way up to 91% from 73% currently, if the plants were to be producing at a B50 level. But we highlight, however, that there could potentially be still technical difficulties, given that at our previous meeting with Probi, the Indonesian Biodiesel Producer Association, they were saying that the road test on cars is still ongoing and will only be completed in June, while the test on trains will only be completed in August. So as such, we think that it is possible that B50 will be implemented in phases, and to ensure that all the trials are successful first. We also believe that there is still a question mark, with regards to the pricing formula for biodiesel, as well as for, potential levy changes. And this is because if you look at where you look at the cost of producing biodiesel now, where methanol, which comprises about 15 to 20% of cost, methanol prices have risen by more than 50% since the start of the Middle East conflict. So the government will probably need to relook at the pricing formula for biodiesel in order to incentivize the players to actually increase production. Given that our conversations with some of the biodiesel players in Indonesia indicate that, margins are extremely thin at this point in time. There's also a chance that Indonesian government may reduce the export levy, given the negative POGO spread currently. So with this move, we believe that the government is actually taking a stance that the conflict could be prolonged. So right now, what we are doing is that we are putting our CPO price assumptions under review, but we are adopting and advising a tactically positive trading stance on the sector. I think, in our previous view, the Middle East conflict would only last for 4 to 6 weeks, and that's the base case scenario right now. And with that, our price assumption of 4,250 per ton for the year will remain intact. Year to date, I think the prices are still between 4,001 to 4,002. But of course, if the conflict is protracted, and crude oil prices remain, above $100 per barrel, or even an escalation where crude oil prices rise to above $150 per barrel, then obviously, this would affect our price assumptions. And of course, with the two, if the latter two scenarios emerge, all plantation stocks would benefit because earnings are leveraged higher to CPO price movements than to rising costs. So basically, we would advise or adopt a tactically positive trading view on the sector right now. And our top picks, however, would remain unchanged. Where we would still like the purer planters, like Johor Plant and Sarawak Oil Palms. We also like the more Malaysian-centric planters like IOI Corp. And of course, the other pure planters in Indonesia, London, Sumatra, as well as the situational plays like STK3 and First Resources. So let me stop here and pass on to David. Thank you very much.
Okay, thanks, Leng. So from the bank side, we are carrying on from what Vincent talked about. Bank Negara held a briefing yesterday also for sell-side analysts in conjunction with the release of their second half 25 financial stability review report. We've highlighted this couple of highlights here. I think firstly on the business sector, this has actually been quite resilient. Business activities has been well supported by resilient domestic demand. If you look at the business exporters, the E&E sector as well as subsectors have done well. Although some of the other sectors, there has been a bit of a softness in terms of the demand side. For the domestic facing businesses, we talk about businesses in sectors like food, basic materials, construction. These ones have also, Bank Negara highlighted, done quite well. Overall interest coverage ratios for the business was stable at 6.4 times. Share of firms at risk improved to 23.7% from 25.9% in June of last year, while the impaired loans for overall businesses improved to 2.8% at end December from 3.1% in June. Looking ahead, the Middle East conflict could see businesses face cost pressures and also, a slower growth environment. And in such a case, Bank Negara expects the larger businesses to be better positioned to navigate through these challenges because of, better pricing power, stronger financial position. The smaller businesses, though, would have faced more challenges, although the central bank did highlight that you have government support measures, and also Bank Negara has in place like your special lower rate funds. All these are in place to help cushion the impact. The household has also been quite resilient because of the low unemployment rate as well as the handouts that receive. Household debt to GDP stable at 84.8%, while the debt service ratio was also stable at 33%. They did also talk about the BNPL and the rising use of it because of, really an increased amount of active users. But the overall share of overdue BNPL debt was still stable at about 3.2%. At this stage, Bank Negara thinks there's limited and isolated signs of emerging stress among the household borrowers. There was, no broad-based trends noted in terms of missed repayments from income groups or employment sectors. Other highlights from the briefing yesterday, Bank Negara did highlight that in their engagement with the businesses so far, there is no suggestion that the businesses intend to delay or postpone the investments at this juncture. So generally, it is still going ahead, and that should be, positive for loan demand down the road. At this point in time, with the timeline for the war still up in the air, we're keeping our overweight stance on the banks. Our top picks are Public, CIMB, and Maybank. Really, we are sticking with the bigger cap. Public is more domestic reliant. All three banks also, you look at their loan loss coverage, asset quality has also been on an improving trend. Loan loss coverage levels are relatively higher versus some of the other banks. So, these banks offer the investors a bit of defensiveness. And today, the dividend yields are actually, have become more attractive again, 6% plus. If you look at our report, the public bank dividend yield is about 5%, but we have yet to include potential capital returns from the uplift that they will benefit from the upcoming Basel III new guidelines. If we take into account that and we make some assumptions around this capital return timeline, that will add about 1 percentage point to the dividend yield, which will bring it up to also about 6%. So again, top picks for the sector, Public, CIMB, and Maybank. Right, so that's all from me. And that's all from us today, I believe, as well. Thank you for joining us. Happy trading, and see you again tomorrow at 8 a.m. in the RHP Morning Kappa at 8.